from my wife, so I think it's a win-win in this house.
Gotta have that distance. We all gotta have our own space.
Not that you know anything about that, Barb, or Tom does. I mean, that's.
I see Jessica on. John is on. We're short some members. I think John was they were gonna go over some of the questions that had been posed regarding the investments.
Yay, Brad's on.
Everybody.
Brad, nobody else got that response when they logged on, but you.
Oh, sorry about that. It's good to see everybody.
Take it as a compliment.
See how many. I'll look and see who responded that they were coming.
Blake not on. I don't see him.
He accepted, but not on.
Okay.
I know sometimes it takes him a minute after club to get the kids out the door and then him to sign on.
I wanted him to be on because a lot of this is around questions that he had posed.
Right. I agree.
Rosie, did you get the new board members added to the invite list? The new advisory people?
Yes, yes, they should be.
I was trying to see if I see.
Yes, they should be.
Is Lucy on the invite? I don't see her listed when I look up people.
She is, but she has a conflict today.
Okay.
Yeah.
And then I'm drawing a blanket. The other person's name. Krista, wasn't it? Yeah, and she's on here. She's on the invite list.
Okay.
Perfect.
Yeah.
Well, we'll give Blake a couple minutes to join.
I did just send him a text as well, Kathy.
Okay, thank you. So before he joins, I'll just add in, as I just asked Rosie about the new members, those did go to the board for approval. So Barb, you're in. Approved for 3 more years.
Hey, Barb.
You can have Tom take you out for dinner tonight to celebrate.
Ooh.
And then Krista Sullivan is going to be our active member. She had some write-in votes. So as we talked in the last meeting, I contacted her and she was interested in serving. So she is also going to be participating. So those are our new members. So we have close to a full slate, I think. I think we have a full slate now. We have 3 actives, 3 retirees, and 3 citizen reps. So we're full slate for first time in a long time. And Brad, there'll be no leaving to empty that slate. I know Brad has expressed some interest in probably transitioning, maybe either off or at least to a smaller role. And that was part of us bringing Lucy on. So we do understand that, Brad, and we know that you have a lot of other commitments.
I'm not in a rush. Just want to share
Okay,
the
good.
joy.
We're not in a rush to lose you either. All right, and Melissa's on. She's listening. So get any response from Blake?
He said, I am close. I don't know what that means. Hopefully close to signing on.
Okay. We'll give him 2 minutes. If he's not on in 2 minutes, we're starting without him. If he wants to join in with some music and dance in the interim. Go ahead. And there's Blake to join us. All right. We've got everybody. John, Alan, Jeff, I believe I'm just going to turn it over to you guys. I know that there's been several questions regarding our investments and some strategies and what if type scenarios. So I'm going to let you guys start, and at any point in time, if people have questions, please feel free to ask, and we'll move on through the agenda.
All right. Can you hear me, Kathy? This is Alan.
Yes, I can.
Okay, great. So what I'll do is I'll share my screen and we'll walk through the analysis that we did. Let's see here, make sure I can do this. Let's see here. Hey, Jeff, do you have this up?
You're
Jeff,
muted,
Jeff, you're
Jeff.
muted.
I think I've got it now. Can you see this? This presentation? Okay,
Yes.
I've got it. So basically what we did is we did the same analysis that we did 5 years ago. And what it involves is it's financial modeling. It's based on modern portfolio theory. It's very theoretical. So think of this as it's a theoretical construct for talking about asset allocation and what may happen in the future. Some of the analysis is based on recent historical data, but other parts of the analysis are based on much longer time periods of historical data and returns for various asset classes. So this is it's about half science, half art. But nevertheless, I think we can draw some conclusions at the end. So there's about 4 slides here. Feel free to ask questions as we go through it. Make sure that I don't confuse anybody, but definitely we just want to do an evaluation of the current asset allocation using this as a tool, determine if any changes are warranted based on this, or if this takes us in a direction for further analysis, that's another possible outcome. But we'll see if there's any recommendations that come out of this. So the first concept to talk a little bit about is the concept of the efficient frontier. And this is a foundational principle in modern portfolio theory. And basically, in summary, the efficient frontier is this red curve. And the various portfolios that we will look at today or talk about today are the 4 boxes here. There's a green box that is a 50-50, excuse me, it's an 80-20 fixed income equity allocation. The next box,
Alan,
the red. Yes.
would you be able to make that any larger?
Let me
The
see
print is,
that. That'll
That
help me
helps.
too.
Yep,
That's a good
thank you.
suggestion because that'll help me get
Thank
through
you.
this. Let's see. So each of these 4 boxes represent a portfolio. The green box is an 80% fixed income, 20% equity portfolio. And as you may recall, going back about 5 years ago, that was the allocation at the time. And then about 3 or 4 years ago now, 4, not 3, we switched to a 70% fixed, 30% equity. And that's what this red box, the darker red box is right here. And then the next one up is a 60-40 allocation, fixed income equity. And then finally, the lighter orange is a 50-50 fixed income equity allocation. Now, The most efficient portfolios, those that provide the highest return for a given level of risk, would sit right on this curve. And you can see none of these boxes are right on the curve. So why are we talking about these boxes today? Why are these the ones we're evaluating and not ones that sit right on the curve? Mostly because to get right on the curve, we'd have to have maybe fixed income allocation of 71.253%, and then correspondingly the equity allocation. So we'd have to make these numbers very precise. And we're rounding off the numbers simply because, again, this is a very theoretical construct. It's not something that's, it's the theory is mostly a structure for talking about this concept, but it is not something that's precise in terms of put the data in and you'll get a precise answer out to your question. So using more finely defined numbers, such as I just mentioned, 71% or 72% versus 70% for fixed income, it implies more precision than is warranted in the exercise. So the exercise is theoretical. So, but we're pretty close to, this gets us off on the right foot by telling us, yes, these allocations just in general are fairly efficient compared to other allocations we could have, risk and return. So moving on, let's look at each of the portfolios in more detail. And each of the portfolios is shown here in the pie charts. So for example, the 70-30 equity allocation that is currently in place, as you can see, is 70% fixed income, which is in the green. And then we've got large cap equity in the red. And we've got, excuse me, we've got orange is international equity. And then this little darker orange sliver is small cap equity. And if you want to, later on, I emailed this to Kathy, and if Kathy, if you want to email this to everyone, feel free. And if people want to look at this in more detail later, you can certainly see right here in this part of the table, the weights of each of these asset classes. Here's the key for each of the asset classes, but here are the weights being used in the analysis that we'll talk about. One of the first steps in doing this analysis is just to simply look at, well, based on the returns of the last 5 years for each of these asset classes, what would have been the arithmetic, what would be the mean, the geometric mean, the standard deviation, and then the Sharpe ratio, a measure of efficiency, return relative to risk. What would those metrics be for each of these portfolios? And as you can see here in scenario A, which is the current portfolio, produces mean returns of 4.5 and 4.3, so call it neighborhood of 4.4 as the return. The standard deviation, 6.7, and then the Sharpe ratio, the measure of efficiency, is 0.68. And so what does all that mean? Well, it doesn't mean a whole lot in isolation all by itself, but what it does, it becomes more informative as we look at other allocations. So if we decrease the fixed income to 60% and increase the equity, we can see, well, sure, the return goes up, but so does the standard deviation or the risk. And we can see, well, is that portfolio more efficient than the one to the left, the one that we're currently in? And we would say, no, it's not as efficient because we want a Sharpe ratio high. We'd rather have them higher than lower because that suggests the higher the Sharpe ratio, the more return you're getting for each unit of risk. So 0.68 here is a more efficient portfolio than 0.62. Now the caveat to all this is, well, I'll get to this in a second. And if we look at a 50-50 fixed income equity allocation, we'll see with that increase in equity, we're getting even more return, 5.7 to 5.2 versus 9.8 on the standard deviation, but the efficiency goes down a bit, down to 58 from 0.62, down to 0.58 from 0.62. And then finally, if we look at an 80-20 fixed income equity allocation, which is again the allocation that we had in the portfolio up to about 5 years ago, just for contrast, we can see, well, with more fixed income than what we currently have, we have a lower return, 3.9 and 3.75 versus these numbers over here. Standard deviation is also lower, or the risk is lower at 5.5% compared to the 6.7 we have now. and all that, we're looking at the return to the risk. We can see that the Sharpe ratio is 0.71 versus the 68. So the current portfolio would be said to not be quite as efficient as this portfolio over here, simply because the Sharpe ratio is higher over here at 0.71. So just looking at this based on the last 5 years, we might say, well, the portfolio we have isn't as efficient as the one we used to have at the 80-20 equity fixed income allocation. However, the main reason we changed it wasn't because we were unhappy with the efficiency. It was the desire to get more return than what we were getting. So efficiency is one consideration, but return is also another. Risk is also another. And actually, risk should probably be first. So this just goes to show that, none of these, just like I said in the beginning, none of these data points are going to give us a precise recommendation or anything like that. This is a construct for discussion. And it points us in the right direction, but it doesn't give us a precise answer to our question, are we in the best portfolio we could possibly be in? So those are some of the foundational concepts right there. We would say that we're not in the most efficient portfolio, but we're pretty close to the most efficient portfolio. And we are getting the higher return that we desire relative to what it used to be. So moving on, or I'll ask any questions about that so far. I think we'll answer some of the questions as we get further into this. But anything so far that I can add to or explain?
Alan, I'm going to throw a question in, and I apologize to everyone that my voice, the stuff going around is in my throat right now. So my question will always be, as we look at this data in a more future sense, is as often as you can make a connection to, we've shifted in the last 5 years as our professional advisors and the managers of this fund, how have the changes we made from 90-10, 80-20 to 70-30 actually panned out in the last 5 years, so that we can sort of put context behind, okay, we know that we are in a less efficient portfolio now than where we were 5 years ago. But my question would be, how is that actually panned out, and what is the net effect for members in terms of, have we seen better returns? Which I know the answer is yes, but how do I begin to analyze the actual risk that was taken during that 5 years? And can you put context in that so that we can look at, as additional risk would come from potential change, how do I know? I don't want to oversimplify it to simple and to what's good and bad, but how do we use the last 5 years to help us guide the next 5 years? So hope that makes sense.
Yeah, in the last 5 years, I think that's a good summary of what's the point of all this conversation. So in the last 5 years, what we've seen is, if we'd been solely in the 80-20 versus the 70-30, you would have experienced, or at least arithmetic mean, you can take your pick on how you want to measure the return, but the mean, the average, the return per year, the average, or whether it's the arithmetic mean or the geometric mean, was 3.9 to 3.75. Instead of that, we got 4.5 to 4.3, or excuse me, yeah, 4.5 to 4.3. We did that by taking a little bit more risk, meaning we had 10% more equity than we otherwise would have had. So the risk is higher, but the return is higher. And we did it, the portfolio was slightly less efficient than it otherwise would have been, which means the cost of the return was higher risk, and it was the ratio of return to risk wasn't quite as efficient as back here. So these numbers are very close, 0.68 to 0.71. So number one, that did increase the return. Number two, it was done without taking significant excess risk, which makes sense, which is what you would want to see. And then thinking about the numbers, and I don't want to get too far into this because I don't want to imply anything on the actuarial side that we're not qualified to talk about. But when we just look at the funding status, back in 2021, even before the equity market made an all-time high in late in 2021, I believe the fund possibly to close the third quarter was at 100% funding, meaning the investments met or exceeded the amount of expected liabilities. And so that suggests that the amount of equity in the portfolio was meeting expectations. Now, meeting expectations that the plan sponsor would have. That doesn't mean that it's meeting your expectations, Blake, necessarily. And we can talk about that. But our mandate to meet the expectations of the plan sponsor, the district, were, we were meeting that. And that's what we aim to meet that. We aim to meet and exceed that. However, when the market dipped, the funding status went to, I think one of the latest numbers I've seen, I'm not sure what the date, what the as of date is, but the funding status was 88%. And almost all that can probably be explained by the dip in the equity market in 2022. And when we looked at those numbers and just did basic analysis and said, well, if the expected liabilities remain about the same and the equity market goes back up to where it was, the plan will return to a fully funded status, funding of 100% or more, simply by the equity market going up and that equity allocation appreciating in value. So step number one is we believe that if we hadn't made that change 4 years ago, approximately, to more equity, the funding status probably wouldn't have been as robust as it has been at points in time when the equity market's been high. There probably would have been more lag in that funding status. And that's very likely not only because of what the equity markets, volatility in the equity markets, but because interest rates and yields on bonds have been down significantly compared to historical levels since the financial crisis in 2008. And only recently, in the last 18 to 24 months, have interest rates risen and yields risen back to levels that were more normal, in air quotes, more normal compared to what they were 15 to 20 years ago. So it's a long answer to your semi-long question, and we'll get into this more, but I think step number one is that the equity allocation, by increasing it, we increase the probability of achieving and maintaining a funding status of 100% or more. So let's see here. Let's move on to the next page and see if this answers some more questions, or hopefully it doesn't create more questions, but it may answer some of it as well. So another way to look at this is to do Monte Carlo, not look at the last 5 years, but look at Monte Carlo simulation and use return forecasts in that analysis based on historical returns for asset classes. And what we have is a group of simulations that produce numbers, expected returns for 5 years, or a 5-year average for each of the scenarios, each of the portfolios. And basically what this is saying is, I'll stick with the middle here. I'll use an example. So the scenario A in the 5-year category of 70% fixed income and 30% equity, the percentile, or the most probable outcome, is a return of 4.34%. If you think of a normal distribution, this percentile, the 50th percentile, would be right in the middle. And then the 95th percentile would be a tail to the left, and the 5th would be a tail to the right, or vice versa, depending on how you're defining your bell curve or your normal distribution. So the most common outcome, expected outcome, is a return of 4.34%. And then if you increase the equity by going down, your expected outcome is 4.89, and then 5.37. And if you back it off to 20% equity, your expected return is 3.8. We aren't as necessarily as concerned about the 95th percentile and the 5th percentile as we are just the middle. If the portfolio is more short-term in nature, we might be more concerned about these numbers out here, specifically not necessarily the upside as much as the downside. If we had, for example, if we had some constraint where we could not sustain a negative return in the portfolio ever, we might care more about the probability of this happening out here, which you can see are negative numbers. These are small negative numbers in over a 5-year period, but nevertheless they're negative. And if there was some stipulation that no, that isn't allowed, then we would have to probably adjust the asset allocation to avoid this sort of thing. But we don't have that guideline or restriction, and so it's just good enough to know that yes, negative returns can happen in this portfolio, but they're not highly likely, because we'll clear out here on one of the tails of the bell curve, and then these returns, they're not large negative numbers. Most likely what would have to happen here is these negative returns are not coming from fixed income, even though fixed income can produce negative returns in a single year or maybe even in 2 years, consecutive years. But fixed income rarely produces negative returns 3 years in a row. This would most likely result from sustained decline in the equity market of more than 18 months, maybe 24 months. It stays down and it doesn't come back as fast as it did, for example, during COVID or even in the financial crisis in 2008. The market returned or recovered most of the decline within 24 months. And this is reflective of that. Even in the portfolios that have 50% equity, this one, scenario C right here, scenario C doesn't produce a significant negative return. So that tells us that, sure, they're going to be, how is that relevant to the plan and the funding status? What it means is that, sure, there may be years where returns of the portfolio are negative, which doesn't help the funding status of the plan, but the negative effect isn't, it's not double digits. It's not anywhere close to double digits. It's single digits. It's low single digits. And so when there is a dip in the portfolio in terms of value, sure, it's gonna dampen the funding status, but it's not going to be, or we would not expect it to be. There's no guarantees. You never know what the market's going to do, but it's very unlikely that the dip in the funding status would be extremely significant. It's not going to be 30 to 40%. It's going to be more like what's been experienced in the recent past, which is maybe 10 to 15%, but a fairly quick bounce back. So if we look at different periods, 10 years and 20 years, you can see that over a 10-year period, there aren't negative numbers over here. And these numbers, they're very similar to what you see up here. So you can see very strong consistency in this middle of the bell curve, in the middle of the distribution of expected returns. 434, 432, 433, whether it's a 5-year, 10-year, or 20-year average return over these periods of time. It's very consistent, which means we expect the value of the portfolio there's a high probability that the portfolio value, it's very consistent on average over a 5-year period, 10-year period, or 20-year period. So nice lower risk portfolio. There's not a lot of volatility. There may be volatility year to year, but over these longer periods of time, it's very consistent. And then over here, over these periods of time as well, here we don't even see any negative numbers. And here we see the worst case scenario is 1.62. So things like that, we don't even expect on average negative numbers over a 20-year period on average. That would, with fixed income, preservation of capital, the nature of fixed income being preservation of capital, that buoys the value of the portfolio and dampens a lot of market volatility on the equity side. That also, one thing I'll point out too, related to this, and you don't see these numbers on the page, but just to kind of finish the thought, if we assume an expected return moving forward, rather than using historical data as is used in this exercise, if we just assume moving forward that yields are at least 3.5% for fixed income and returns are 8% for equity, which would be very reasonable compared to historical data, historical returns, historical results, and we do a pro rata allocation of those returns across the portfolio, 70% fixed income, 30% equity. That gives us an expected return of 4.8%, which is a little bit higher than these numbers here. So bottom line is this data here, plus the rough data that we use in a separate exercise of using historical returns, which produces a pro rata expected return of 4.85% specifically. Call it 4.8 just to not imply more precision than is warranted. Gives us a lot of confidence that 4.5% is a very likely expected return for the portfolio. Can it be higher? Sure. It can be higher. And basically, I think it's fair to say between 4.5 and 5 is a high probability of the portfolio producing that on average over a long period of time. And the more yields go up and the more yields stay at the levels they're currently at, and the more bonds mature and the more that are replaced, the more bonds mature and the more they're replaced with bonds of higher yields, the higher the probability that the expected return is in the 4.5 to 5% category. And I think there's a good probability that it gets above 5%. We're just not there yet because the movement up in yields is fairly recent in in the past. It hasn't been in place for 3 or 4 years. But if yields and interest rates can stay, they may not stay quite as high as where they are today, but if they back off only a little bit, for example, if the 10-year goes from where it's at today, backs off to 4%, and other bonds, corporate bonds, et cetera, their yields decline a little bit, but not back to the 2 to 3% that they were 3 to 4 years ago, then there's a higher probability that the 4.5% to 5% return on average is kind of where the return is going in the future rather than where it's been. So let's see.
Alan,
Go
did you
ahead.
consider any like liability cash flows in this analysis, just to kind of account for, there's money coming in, a lot of money coming out through benefit payments? How is that incorporated into this analysis? And do you have any perspectives on like what the sort of like hurdle rate is on this to maintain, funded ratio across any of these while considering liability cash flows as well?
We haven't incorporated that, in the absence of having, I don't know, what the actuarial data would be at this point or when that was last refreshed. So we haven't done that. And we kind of, this analysis would be separate of that.
Okay.
Yeah.
You're just thinking like, plan
Yeah,
funded status is sort of.
Go ahead, Jeff.
Go ahead.
Yeah, if we can get the data, we can put it into the analysis. The software does allow us to input that liability data. So if you have a hurdle rate or something like that, yeah, we can certainly back out a lot more analysis based on if we do get those cash flow components. Or if you provide a hurdle rate, we can use the current cash flow. But again, we would need the actual data because of the aging of the
Yeah,
of
Kathy,
the
that seems
yeah.
like a good connection to make. Maybe if we can get some of that data from the actuaries to the BTC team to incorporate some of that stuff, because I appreciate the efficient frontier analysis, but if it's an asset only analysis, I'd rather it be like a surplus efficient frontier as opposed to
Yeah.
just an asset efficient frontier, because that gives us a better picture of like what the funded status of the plan looks like and how these different asset allocations impact the funded status, which is ultimately what we care about, right? That and
Exactly.
plan holder or policy holder outcomes, right? It's kind of a combination of those two. And so I don't know. And then also, I guess, how these returns influence eventually what your liability value is also kind of matters too. Just thinking about what all the factors that go into like health of the plan and outcomes for the policyholders or the participants of the plan.
Yeah, Brad, thanks for that question, because it's a similar exercise that we would do for an insurance company where we're doing, we're doing our piece of the asset liability management analysis. And like you just said, we can do analysis like this and we can calculate expected returns. But we don't know if the expected returns, we don't know if the expected returns will achieve 100% funding status and to what degree they would provide surplus.
Yep. Is this a proprietary software you guys are using, or using like Moody's?
It's a Zephyr product.
Well,
so
Actually, this analysis is done via Morningstar. And
okay.
as Jeff
Yeah.
just referenced, Zephyr, we are in the process of migrating from the Morningstar platform for this type of analysis to Zephyr. More robust, much better support than we've had experience with for the last few years with our current vendor. So we are moving up the learning curve quickly in terms of the capabilities of the new vendor. And so in the future, that'll be what we will be utilizing for presentations like the one we're looking at today.
Okay. Makes sense.
So from my standpoint, what actuarial information do you need? We just had an actuarial valuation done of the plan. Do you want that? Or what specifically do you need?
Yeah, if you could send us that and actuarial analysis, that would be great.
Yeah. And
I think like
And will do.
contribution and payouts likely to kind of
Yes.
say like what's net customer
Yep.
cash flow sort of thing. Yep.
Yeah,
Yes,
and
we
what,
can see if it's lumpy at all or not, that kind of thing.
and what kind of hurdle rate they may have included in there in terms of maintaining the desired funding status.
Because one thing to consider with this analysis here is that it's sort of agnostic to timing of returns. But if you have a pension plan where you're drawing down on funds, a big negative year earlier on is painful because then your subsequent returns, they have, you know, guaranteed payments coming out of a smaller asset base. And so then the returns on the recovery are applied to a smaller dollar amount. And so it's
Right.
much harder for the plan to kind of catch up in terms of funded status. And so
Yeah,
that's where, you know, the surplus type analysis would be maybe it'd give a different perspective, I think, than what you're offering here.
we agree, and that would be common. That would be kind of normal sort of analysis for us to do on with the liability data in hand. So, we will refresh this when we have that data. We will incorporate it. I'm not sure exactly what form that'll take, but if we can get that fairly soon, then we can at the next meeting discuss that. I think given your points, Brad, that going on to the next page is kind of a moot point because it's just another way to look at the returns. But really the key, as you pointed out, is the hurdle rate. What is that? How close are we to it? What does that imply about the funded status? And then I think, Blake, to your question, not only, I don't want to put words in your mouth, but yeah, you want to know what the funded status is, but you also want to know what the size of the surplus might be. And are there ways to increase the size of the surplus that makes sense? So, for today, all I can say is that we do continue to believe that the 70-30 allocation is appropriate. It's necessary to have a high probability of achieving and maintaining a fully funded status. Certainly backing it off is going to reduce the probability of that. I think whether or not we would be inclined to recommend increasing the equity allocation further, that would certainly introduce risk. It would improve the expected return of the portfolio, but it would introduce additional risk. And if there was interest in, we'll take a look at that and talk about that next time. But if there's certainly interest in doing that, I think given the added risk, then it would make sense to loop in the board on that discussion. So ultimately, I think they're the ones taking the risk, and so we can certainly have that conversation. But if we get too deep into that, I think we need to loop the board in. So
is this analysis just like public equities and like a public fixed income type index and that you're modeling off of here, or are you incorporating like private asset classes at all? And no, okay.
No, it's just
I think of efficient frontiers like ways that you can sort of like see improved results are through diversification, right? So your downside risks offset each other. Equities and fixed income do that in some ways, right?
Right.
But also private asset classes tend to look better from a volatility perspective, artificially, maybe, I don't know. But they also tend to have a premium associated with them. So I haven't looked at our holdings in a while, and I look at enough portfolios that I get sort of mixed up. But do we have any private assets in this portfolio? Is that available to us anywhere?
We do not. And we do not. And part of the reason is the illiquidity of the private assets.
Mm-hmm.
You just touched on a second ago. Part of it's the illiquidity, not that there are large distributions coming out all the time, but putting a 5 or 10% allocation of something like that in here would definitely it could lead to a pinch on funding distributions depending on the timing of when the private equity, the lockup periods expire and things like that. And the other things we've seen, but the bigger issue we've seen in the past is, unless you're talking about doing a $25 million or $50 million allocation to private equity, it's just very difficult to get into quality funds that can produce a return that's at least, we look at private equity and say, at a minimum, we want a 2.5% return beyond the S&P 500. And really, we'd prefer at least 5. And historically, the asset class has done that. But in the last 15 to 20 years, funds that do that have been funds that do that you can access in allocations of less than 50 million or less than 25 million have become rarer and rarer. And so quality of the funds in terms of the returns plus the illiquidity have led us to sort of shy away from those assets, even though we have invested in that class in the past.
Yeah.
So
yeah,
I know, principal, you probably see portfolios a lot, with that type of thing. The universities have those types of allocations. But a lot of the reason is they're so large that they can afford to have 50 or $100 million or more, billions actually, in that class.
right.
So
There's sort of a minimum investment to get into the deal, and that would be a prohibitively large portion of our portfolio in most cases, I imagine. So that makes sense.
Exactly. Yeah.
Yep.
It's not quite the size you can do that. And then the portfolio declining in size makes it even more difficult.
Yeah. Yeah. So you almost wonder if there's some sort of like a fund that could accommodate that sort of a thing, and what our policy guidelines need to adapt to accommodate something like that. But no, I think it's a good thing to chew on, right? I think around like liquidity and what are our liquidity needs for this portfolio. I imagine we have 10 times liquidity that we need right now, and usually you can get better return for liquid assets, not without risks, right? But if you don't need the money in the next 10 years, it's an opportunity to increase spreads.
Yeah, private assets liquidity it's a consideration. It's something that could be an issue. Right now, it wouldn't be an issue for this portfolio, but it could be down the road at some point, depending on the timing of asset with distributions. That's really not the biggest concern. More of it is just, again, over the quality of the funds that can be accessed has become less and less, has declined. That's the bigger issue that we've encountered. And we partner with Goldman Sachs. We've explored opportunities with JP Morgan. I've worked with JP Morgan in the past with insurance companies, insurance clients that I've had in the past in doing private equity allocations. But with JP Morgan, the minimum investment was 10 million, and the returns were good. But investing in $10 million chunks, this was being done in a $500 million portfolio, so you could fit it in there. You could fit it in there, and you didn't have to worry about liquidity too much. But here, I know, and Jeff and I and John and others have talked about it, not only for this portfolio but for other portfolios, and doing allocations that are that big, unless the portfolio is 250 million or larger, it's just really hard to fit in a $10 million allocation.
Yep, that makes sense.
Um,
Active retired members, do you guys have any questions about the last 5 minutes of nerd talk that we could clarify anything for you? Okay, just wanted to make sure we're not talking to ourselves too much.
No, Blake, I know that doesn't cover everything today in the question you had earlier, but I think we're moving in the direction of we'll complete that question with the liability analysis added to this analysis. So any other thoughts before we go back and round out our analysis?
Yeah, I think I'll throw in one thing, which is I think it's important as a group, and I almost wonder if we, for the purpose of this question, exclude active members, is to clearly identify what is our floor that we have to achieve year over year for returns just to cover the basis for our retired's guaranteed interest. And so when I see some of those returns and I see 4.3 as sort of the general 50% line, that starts making me be a little bit nervous because I know that's going to be right on the edge of basically covering the expense for our retired members. And then it likely creates a dynamic where excess earnings is not really in play in the conversation.
So there's a couple ways we can attack that issue. If we can get the separation of the cash flows between the two, retirees and active, then we can look at it on a segmented approach from the asset component so that certain of assets are applied to different types of payment requirements associated with it. So we can do segmentation of the ALM process if we need to kind of proof out, and we can move assets around to the segmentations that we need to validate that they make the cross the finish line. So if we can get that separation of asset streams of the liability payout streams, then we can do a segmentation analysis to verify that. Yes. Yeah.
So Jeff, you're talking about, just to make sure I understand, you're talking about looking at the expected liability or payouts to the actives as one
Yes.
group, the expected liability or payout of the retirees as another group, and then looking at the assets overall, and I wouldn't say call it matching necessarily, but making sure that the liabilities of both are covered, not only in aggregate, but as if you look at it as two separate groups as well. Is that correct?
Yeah, and then the risk profile of an active versus a retiree is different. So it would be identifying assets that match that risk profile, or because the hurdle rate might be higher of one group versus another, assigning assets to a particular group. So it's a common feature done in life insurance and others is the segmentation of assets. So yeah.
Okay.
And
All right,
Jeff,
Fran.
does it, oops, go
Go
ahead,
ahead.
Jessica.
No, you go ahead, Kathy. Yeah, I'll wait.
Jeff, does it matter on our active group? There is not a huge variance of age within that population. We have kind of a heavy concentration of the almost or eligible to retire group. And then there's very few members who are under that. So for segmentation purposes, I think that's important to note. I can certainly send you that data, but I also want to note that a lot of those in that active population are ready to jump to the retiree population.
Yeah, and Kathy, that's what I was going to say too, is that a large majority of our people who are active right now are 0 to 10 years from retirement.
Mm-hmm.
So most of them are right in their 50s. That's where most of them are at the moment. Not everybody, but most. So we are closing this plan down. We're not accepting new members. Eventually, we will be 100% retirees. That will happen. So as we're thinking about this plan over the long term, how do we keep it so that it will sustain the folks through their retirement? What strategy do we need to have as we close down this? Because we're going to get to a point where we're not getting contributions except for what we earn through our investment strategies. So I think that's what all of Blake's concerns are about, since odds are he's going to be one of the last ones still in the plan, because closing it down means that everyone in the plan eventually passes away, right? Like, so that's when it will end, right? So Blake, we want to make sure that you have something to live on in your golden years, ideally. So that's as you think about the strategies we want to look at. And I'm hearing you talk about you want to do looking at the liabilities and as well as the assets. I get all of that. But the bottom line for me is, can we develop a plan and an investment strategy so that we can match the life of this plan to the life of the members?
I think, Jessica, we're on target to do that. I mean, we don't know what the market's going to do. So, but I think the funding status, that's in pretty good shape. And I don't know, Jeff, if you're nodding your head there, but we've talked about that internally. And again, we're without looking at the liabilities in a lot of detail. From the asset side, we're looking at it and saying that, again, the equity market needs to continue to go up. It doesn't need to go up a lot, but it needs to continue to do what it's done for the last 150 years, which there can be lots of volatility year to year, but you draw a line through it over the last 150 years and it slopes up. And so as long as it keeps on doing that, and there's no reason to think that, that's not going to be the case. Again, no guarantees, but, in our world with our clients, that's a general assumption that you have to make. And that provides as much certainty as possible, no guarantees, but as much certainty as possible about the funding status. And so when we sit and think about it, it's sure the funding status is one thing. Whether or not there's a surplus above that and how big that surplus might be, that's a different question. So a different question with more variability or uncertainty in it. The fair statement, Jeff? Fair statement, John?
Yeah, so the terminal value will vary depending on, just as Alan mentioned, what the path of rates are in the future, and then what the changes in the cash flows associated with the liabilities. We all know that Blake is going to live for a very long time. So we got to make sure that this is going to be.
Go for 100, Blake.
Yeah, it depends how long that stream of cash flows, that annuity needs to be there. And again, I think it's one of those policies, one of those plans where winner takes all. If he's the last one, he gets whatever's left over. But we want to make sure that that's sufficient, that there's a sufficient coverage ratio. As Alan pointed out, the funding ratio is really the important thing because it already takes all these factors into account when they calculate that funding ratio. So, a lot of this is already in there. What we're doing is just talking about taking essentially what's already in the actual study about the assumed investment rate and the assumed return rate and see if we can improve upon that and or reduce the risk profile that, to get to that rate. Can we achieve that with a lower standard deviation component? And again, the timing of the cash flows, as you mentioned, with a large number, what we call this is a closed block of business, essentially a closed set of liabilities going forward. With that, the cash flows, whether we have them separated for active or not, because of this becoming a closed block, it may not be that important to have two separate cash flow streams in order to come up with the solution set you want. But, if we come up with an answer and you want more detail and you want it separated out, that certainly can be done. This software does allow us to put in these liabilities and some assumptions associated with them. So but we look forward to the opportunity. This is a pretty straightforward process. So thank you.
Kathy, do we still have the plan actuary who did the surplus study? He was a newer guy. He had an Excel spreadsheet that was very detailed. And do you remember that analysis that I'm talking about? Do we still have that guy? And I assume he still has that tool.
Our current actuary is Larry McNamara. I
think so. Yeah, I think that rings a bell for me. Just wondering if the information flow could go both ways, because he already has sort of under different scenarios, what does the funded ratio look like? And so we could provide him with these distribution of returns for different horizons, and he could share his analysis. We're mapping the BTC analysis to Larry's analysis. It'd also be helpful, I think, for the BTC folks to get Larry's analysis to kind of validate their tools and have it going both directions, right? But it may be quicker for Larry to kind of plug this into his tools that he built for us and give us sort of his perspective, and the BTC folks can do the same to validate their tools. Just have different data points.
And I'm wondering, Jeff, would you be the person for me to have our actuary connect with? It might be easier for the two of you to have a conversation rather than me be the intermediary on what information you need. I have a feeling with me as the intermediary, it might lose something in the translation.
You do a
Um,
great job, I'm sure.
Thanks, Brad. But Jeff, what I might do is reach out to our actuary and provide him your contact information.
Mhm.
And then the two of you can be in touch. I've already reached out to him during this call to see if he can send me some electronic copies of some things to forward to you. But I think maybe that conversation directly between the two of you might be the best.
Yeah, that works great. We can talk through the scenarios and what the inputs are into his model, so that either we can get those inputs into his model, make sure that they're consistent, and then if we can make some improvements on the model aspect, we'd certainly be happy to contribute that aspect as well. Yeah.
Okay, I'll make sure that I get the two of you connected. And then are there any other questions for our BTC guests? I have one final question for you guys. We are looking at changing our meeting structure to meeting quarterly rather than monthly. And I want to work around the quarterly financials that we get. Right now, we're meeting the second Wednesday of the month. And I feel like if we go to a January, as the first meeting of the quarter, January 10th is that too soon to have year-end financials? What I'm proposing is maybe rather than do a January, April, et cetera, quarterly meeting, we start with February as the first meeting, so it gives you time, and then we'll always have completed financials for our meetings. Would that make some more sense?
Yeah, I think that'll work because, yeah, the returns per each month, the returns are finalized or approved by the 10th or the 11th. And then if we have a day or two to produce the full report, pretty much by the 15th of any month, we can have a report to you.
So yeah, I think if we stick with, does this group think if we went to quarterly meetings and start with February being the first meeting and then 3 months following, et cetera, does that work? All right. Hearing no arguments from that. Rosie, if you could change our meeting structure and just start with February, the second Wednesday of the month, and we'll meet quarterly. If for any reason there's a need to pull any extra meetings in, we can. But right now, let's just stick with that quarterly.
It'll be a fun Valentine's Day together.
Oh. Oh, Blake, you know how much we want to spend Valentine's Day together.
Money and chocolates. Here we go.
We'll make it quick so you can still go out for dinner. We'll be done by 5. And then I also noted, Matt, are you still on? He was here. I think he left us. I was going to ask him to provide an update on the early retirement question that is asked monthly in this meeting. I do know that we are meeting, I think it's sometime late December with the superintendent regarding that. So hopefully we'll have an update shortly. Just wanted to provide you with an update on that. What?
I think you meet the 21st.
I think so too, because Shashank gets back on the 19th. And so we're like hammering all these meetings in as soon as he gets back. So I think it's the 21st so we'll get that done. And then anybody else has anything, let me know. Other than that, we will plan on meeting in February on Valentine's Day. And I'll connect everybody on the BTC side with the actuary, and hopefully that will provide us with some information for that February meeting.
Thank you.
Great.
All
Thank
right.
you very much.
Thanks,
Have a
everybody.
good holiday and thanks for all the hard work this year.
Thank
Happy
you.
holidays.
Thanks.
Happy
Thanks,
holidays.
everybody.
Happy New Year.
Thank you.